Session of Corporate Law and Other Economic Laws. Welcome you, sir, and over to you, sir.
Very good morning, my dear students.
Good morning, sir.
Good morning, sir.
Morning. It's my proud privilege and honor to be with you. I hope students have gone through much of the portions. So I remember in the last session, we covered up to 42 classes. In fact, the 42nd class was just an introduction on what to read in the Foreign Exchange Management Act. The whole 2 hours almost I spent giving you some background as to what is foreign exchange, why is it foreign exchange so important for the economic development of the country, to what extent the country is dependent on the adequate availability of foreign exchange, what is foreign exchange crisis, what is foreign exchange surplus, what is devaluation of rupee, what is convertibility of rupee. With lot of economic problems which we are facing, I gave you enough background. So in this background, if you read the Foreign Exchange Management Act, you will find it quite important, quite interesting. So the point here is, it's not just reading from the examination perspective alone. Yes, examination perspective is very important. But apart from that also, what is important is you should know the background behind this foreign exchange. Hence, I spent a lot of time trying to understand as to what exactly is this foreign exchange and all that. Right, in class number 43, directly we go into the subject in class number 43. So first, there are some definitions which are given. Out of the definitions, foreign security definition is also important. But the most important definition is the person resident in India. Quite a lot of times he had given in the examination. Because the entire applicability or non-applicability of FEMA is based on the residential status of a person, not on citizenship status. Let us not be under any wrong impression that FEMA will not apply to Indians, it will only apply to foreigners, not necessary. So if you are a resident, most of the provisions of FEMA will not apply. If you are a non-resident, FEMA will definitely apply. Therefore, a non-resident Indian also has to comply with the provisions of FEMA. So what is the definition of resident? I have elaborately explained for more than 1 hour, divided into 3 parts, and I have explained. And there are a lot of previous questions also I have gone through in that. And not only individuals when they become resident, when do a branch or office or agency also become a resident? So very interesting point is, if the branch, agency or office in India owned or controlled by a non-resident is also resident. Similarly, a branch, office or agency outside India owned by a resident is also resident. A branch in India obviously owned by a resident is very much resident. So who is a non-resident? A branch or agency or office outside India owned or controlled by a non-resident is only a non-resident. The remaining other 3 permutation combinations definitely come under the definition of resident. So all the issues also have explained very clearly that it is the definition is based on both the parameters, the period of stay as well as purpose of stay in India, unlike in case of Income Tax Act, which is of course based on only period of stay in India. And who is a non-resident? A person who doesn't come under the definition of resident is very much a non-resident. All these things I've explained very clearly. And also almost we had done about 10 questions or so in the definition of resident. Thereafter, we went to person of Indian origin, because we give lot of concessions to person of Indian origin. Even though he is not connected with India now, he has got the foreign citizenship or dual citizenship. That is, in other words, practically has no connection now with India. He's not an Indian citizen as of now. But if he had any time earlier held Indian passport or he or his parents or grandparents was any time an Indian citizen, or his spouse is an Indian citizen, then this guy will get the status of person of Indian origin. And as I already told you, quite a lot of concessions are given to you. So these three definitions, you have to focus a lot. What is a foreign security? Who is a person resident in India? And of course, non-resident means a person who is not a resident in India. Then a person of Indian origin. These are some definitions where quite frequently are given in the examination. Then we went to the main section, restrictions on dealing in foreign exchange and foreign securities, section 3. In other words, these three main sections, they say, if you deal without RBI approval, they become Hawala transaction. And if you want to send any foreign exchange inside the country, it has to be routed officially through authorized dealer, authorized money changers. All those points I've told you. Then you cannot hold also foreign exchange with you. These are the basic restrictions which you find in section 3 and section 4. Right. Then, having understood all these definitions, the more important focus area in the Foreign Exchange Management Act is dividing the entire transactions, foreign exchange connected transaction, into capital account transaction and current account transactions. Because most of the provisions are applicable based on this classification. So quite a lot of questions are also given on that. If I remember correctly, the last 25 years, 20 years at the most, that is about 40 sessions, surprisingly around 30 sessions, you had a question in the current account or capital account transaction. What they do is, first they give the transaction, you have to identify whether it comes in the definition of current account or capital account transaction. Having identified that, then what are the approvals which you have to take for this transaction, whether it is exempted, all those points you have to write. So I spent a lot of time trying to explain what is capital account transaction, what is current account transaction. So first we had explained what is capital account transaction, because current account transaction is a transaction other than capital account transaction. So the focus had been more on the capital account transaction. Today, because of the comfortable position of foreign exchange, which I've explained earlier, which is not because of exports and all, we are in a comfortable position. Only because of foreign investments in India, we are in a comfortable position with regard to foreign exchange. So, capital account transactions, having understood that, again in capital account transactions, we have three categories. One, transactions which even restrictions cannot be imposed. That list you have to by heart, because even though for namesake it's a capital account transaction, it is freely permitted like a current account transaction. So this list you have to go through. Second list is the real capital account transactions where RBI approval is required. Then the third is prohibited capital account transactions. So what I did, how to remember the various items in the three list. So for this, a easy method I found out. Let us focus more on the first list and the third list. That is, freely permitted capital account transaction, almost treated like a current account transaction. The last list, prohibited capital account transaction. So when you focus on these two lists, obviously the remaining transactions will be coming under the second list, which will be permitted with RBI approval. So go through this definition very, very carefully. I've given a lot of examples, means which very simple, a transaction which alters the assets and liabilities outside India of a person resident in India, or a transaction which alters the assets and liabilities in India of a person resident outside India is a capital account transaction. In other words, for a resident, if it's the crude way, if you remember, for a resident, balance sheet transactions outside India, and for a non-resident, balance sheet transactions in India, they will all come under the definition of capital account transaction. And for removal of doubts, the government has released a list of transactions where if you think you have some doubt, for removal of doubt, they made it very clear. all these transactions will come under the definition of capital account transaction only. So go through all that very carefully. Quite a lot of questions are given. So this up to here I've explained in 43, class number 43. Then continuing the discussion, class number 44, I focused more on transactions where RBI restrictions also cannot be imposed. So what he can give in the examination is, he will create a situation, a practical situation, and try to give in the examination as such. So you have to be very careful, go through all that very carefully. Then comes the second list, as I already told you. Just remember the list as a formality, because we are going to focus more on list 1 and list 3. Whatever we have not discussed, but coming within the definition of capital account transaction, will go under list 2. And in list 2 also, there are 2 subdivisions. One is capital account transaction for residents outside India. Second is capital account transaction for non-residents in India. Then I went into the third list, prohibited capital account transactions. They are of no use to the country. Even government also cannot give you approval. Reserve Bank of India government also cannot give you approval. Because if you allow this, the money will go away as a hawala transaction. These are no use to the country. So the business of chit funds, Nidhi company, agricultural plantation activity, we are not going to allow any foreign investments in India. Because as I've been telling, East India memories are still fresh. They came to India to do trading, and rest is history. They lived in the country for hundreds of years and left the country in a total shambles. So basically 80 to 90% of the population is dependent on agriculture. So if you allow foreign investments to come into India on pure agriculture plantation activities, then probably each sheikh in Saudi Arabia will purchase 5 cities and 10 cities. Then probably the CM of any state also has to live in that particular area only. I mean, leaving all that aside. So they are all prohibited capital account transactions. And real estate, farmhouses, pure real estate, then he has given a definition, what is not a real estate, there it is permitted. Only buying and selling of land has been prohibited. Then TDR, transferable development rights. So in the third list, we focused. So this is how extensive discussion with examples are given in the list 1 and list 3. Now, having understood what is capital account transaction, rest of all the transaction has been brought under current account transaction. And current account transaction is relatively free from RBI control. So current account transactions are almost easily permitted. Once you come under the definition of current account transaction, you have to go to the authorized dealer, fill up the necessary forms, giving the necessary undertaking. And if you give the necessary rupees, you will convert into dollar and you can just go ahead. So that is the great advantage for the chartered accountants, company secretaries, and other professionals today, because most of the day-to-day transaction with non-residents are being classified under current account transaction as such. But in the definition, for removal of doubts, they have said current account transaction is a transaction other than capital account transaction, and without prejudice to generality, such transaction include. So these 4 examples, they're only examples. So actually in the main definition, it's there. Any transaction other than capital account is a current account. So these are only examples which are given. Having understood what is current account transaction, in current account transaction also you have 3 listed. Schedule 1, Schedule 2, and Schedule 3. Schedule 1 is a prohibited current account transaction like capital account. Then Schedule 2 talks of current account transaction which will be permitted with central government approval. Then Schedule 3 talks of current account transactions with RBI approval. So how you have to approach the subject, I've told very clearly. First, having identified that it is a current account transaction, you have to go into list 1, Schedule 1. If it is there, prohibited, forget it. If it is not there, go into Schedule 2. If it is there, then prior central government approval, the concerned department's approval you have to take. If it is not there, jump into Schedule 3. If it is there, the transaction requires RB approval. So now how do you understand a current account transaction which is not covered in Schedule 1, Schedule 2 and Schedule 3 is a pure current account transaction? You can go ahead. So in the examination, what they do, they try to give you the transactions list and you have to identify whether they come under Schedule 1, 2 or 3. If they come, the respective provisions you have to write. If they don't come under any of Schedule 1, Schedule 2 or Schedule 3, then you can say that current account transaction is a pure current account transaction and that will be permitted without any kind of approvals. As I already told you, you can directly go to authorized dealer, then fill up the necessary forms, give the undertakings, and once you give the rupees, you will convert into dollars. This is what I spent a lot of time explaining the 3 set of transactions in this class, in class number 44. But students must remember, since in each list you have 13 items, 14 items, you have to simply spend time and by heart. There is no other way. Then as I have basically, I'm against this concept of by hearting. So I've given a lot of examples with some humorous examples also in the 3 list, Schedule 1, Schedule 2 and Schedule 3. And please remember, Schedule 3, which I've given the latest figures. Don't check up the books which were issued 4 years or 5 years back. Don't make any corrections in my material. They're all the latest material which are now applicable to you for writing this November 20 examination. So in the 3rd schedule only, current account, you have to understand the current account list. Up to a particular limit, two meanings you will get. Up to a particular limit, say $250,000, pure current account transaction. More than $250,000 only, RBI approval will be required. Now, what is technically the difference between Schedule 2 and Schedule 3? Wherein in Schedule 2, you require central government approval. Schedule 3, you take RBI approval. Central government approval means they will look into certain policy decisions. It's difficult to obtain the approval. It's not just simple, easy to obtain. No. Central government in hundreds of cases have refused the approval, which means there is adequate Indian facilities available in India. Why do you drain out unnecessarily foreign exchange from the country? So from the foreign exchange angle, many of the approvals have been refused. Right. When it comes to Schedule 3, where RBI approval is required beyond a particular limit, RBI more looks into procedural aspects. Why you require so much foreign exchange? Are you a taxpayer? Or are you a foreign exchange earner for the country? Or are you a very important person in India? Do you reflect the culture of the country? Those are the areas RBI will look into and give the respective approvals. So up to here, I have covered in class number 44. Then in class number 45, continuing the Schedule 3 transactions where RBI approval is required, I spent quite a lot of time going into all the previous year questions. You will not believe almost 20 previous year questions, each and every question I have addressed. Each and every question I have addressed. Of course, the answer book contains all the answers also for that. The idea is not just jamming everything. The idea is logically you try to remember, probably then the need to by heart will not arise. This is what I've done in the class number, what I was telling you, the class number 45. In class number 45, once I finished those previous year papers, then we went to a next topic, payment of remuneration to foreign technicians. Nowadays, a lot of small scale industries, medium industries, and big industries also, you have a lot of technicians. Foreigners come here and work in India as technicians. Then obviously the payment has to be made to them. You make in rupees and they send and convert them into foreign exchange and send to their country. The background is the same. Since we are now in a very comfortable foreign exchange position, government has relaxed all that. So any salary which you pay to a foreign technician is a pure current account transaction. So no restrictions. Whatever rupees you pay him, he can go to authorized dealer, convert into foreign exchange, and send it without any limit. So of course, it should be as per the contract, whatever salary he gets. And if the tax deduction, income tax at source, TDS, if there's a deduction, that you have to deduct and remit to them. Then next subtopic was remittance of dividends. As I told you, dividend is a pure current account transaction, whether you pay to foreigners or non-resident Indians or any foreign institution or any person, they come under the current account transaction. So now the job of the chartered accountant company secretaries have become quite easy. So what you have to do for residents, absolutely no problem, we pay in rupees. But for non-residents, you go to the authorized dealer, fill in the necessary forms, declaration and all, then give him the list and pay the money to him. He will directly convert into foreign exchange, dollars or whatever it is, and then credit to their respective accounts abroad. So this is regarding remittance of dividend. Then another small topic of discussion was appointment of foreign nationals as a directors in the board of Indian companies. Now, when you find a lot of relaxations, when you want to appoint any person outside India, you can appoint him. No special approval under Foreign Exchange Management Act. Of course, the basic requirements of disqualification of directors given under the Companies Act will obviously apply. So he should be a person who has regard for law and he should not be disqualified. But for that, if any foreigner is appointed as a director in Indian company, my point is no special approval under FEMA is required. Then having told all this, and you can even pay that sitting fees, expense reimbursements, that 1%, 3% commission on profits to these ordinary directors, and they can also be remitted. So those clarifications are there. See, I've been telling right from the first class that each and every point you must go through. That is the secret of success. Calmly you must read. That is why, you see, what I've done, if you have gone through all these 40 plus classes which I have addressed, what I've done, apart from making your life miserable, what I've really done is, I did two things. One, I told you how to read the subject called law, not just cramming, enjoying the subject, understanding the subject, and conceptually understanding the subject. This is what I've done. And second, I removed the fear from you. That's what the major issue. Because we focused on each and every point. So a challenge the examiner was what I told you. Let him give anything in the examination, you will be able to write. As I've already told you, I'm taking you to a high plane of preparation. Even if you are prepared at 70-80% level, which I'm taking you, you will get the 70s and 80s in the examination. And no selective preparation, which I've been telling you. That is the mantra. That is the secret for success. Page 1 to page last is very important. So each and every point you must read as if it's a separate topic, separate subject by itself. And anything he can give in the examination. Right. Having discussed that, then we went into immovable property transactions. The Reserve Bank of India has released a lot of guidelines, and they said immovable property, which is a capital account transaction, that is, the resident wants to purchase immovable property outside India, or non-resident wants to purchase immovable property in India. What are all the approvals required, which come under exempted transaction, all those points. So first one, acquisition of immovable property outside India. Acquisition of immovable property outside India by resident. Outflow of foreign exchange, very stringent guidelines you have got. Where there is no outflow of foreign exchange, probably automatic approval is allowed. For example, like a foreign national, who is having a lot of property outside India. For him, if he is a resident, For him, if it touches all this, it becomes a capital account transaction. Since he is not going to take any money from RBI, those are all permitted without any kind of restrictions as such. So most of them, otherwise, very difficult to obtain any approval for transactions, for capital account transactions outside India. The idea is you become a non-resident, then you earn the foreign exchange in that country, then using that foreign exchange, foreign securities or immobile properties you already purchased, then you try to sell and then purchase new immobile property. That is what Government of India is trying to permit you. The idea seems to be, as far as possible, bring the foreign exchange inside the country. And if you don't bring also, fine, at least from here, you should not take any foreign exchange for capital account purchases. That seems to be the idea. You earn the foreign exchange outside the country. And some 1-2 questions are also given. Then the second part of it, which we have addressed, is acquisition or transfer of immovable property in India. That is non-resident. When he wants to acquire immovable property in India, what are the guidelines? Here there is an inflow of foreign exchange, so slightly relaxed guidelines you have got. So what the government did, they divided the guidelines into 3 parts. I repeat again, acquisition of immovable property in India by non-residents. So what the government did, divided the thing into 3 parts. 1, NRI, non-resident Indian, is an Indian basically. So what kind of restrictions you can put? Nothing. So very relaxed guidelines you have got. So you need not bring even foreign exchange inside the country. If you have got rupee account in India, you can use money from there. So he is basically an Indian. So how can you put the restriction? So you can purchase any immovable property in India. You don't have to bring also foreign exchange inside the country. But only restriction is you should not touch agricultural land, plantation, and farmhouse. These 3 you cannot build. So guidelines comes to an end. Then the second set of guidelines is person of Indian origin, which I've discussed earlier. This person of Indian origin, what kind of guidelines you think you have got? They also, since they had some Indian connection earlier, they can also purchase any immovable property in India to any extent, other than agriculture, plantation, and farmhouse, but they must bring foreign exchange inside the country. That is why we are permitting them to come. So they have to bring the foreign exchange inside the country, either direct remittance, or if they are already brought through FCNR account or NRE account, you can use that foreign exchange. Right. And the third set of guidelines is foreign exchange coming inside the country from non-resident, pure foreigners and all. Very stringent guidelines. And these foreigners can come inside the country only when they have got a project or some business which has been approved. See, this is what I've been telling. Indians have left the country. Indians are allowed to do anything in most of the foreign countries. Indians can do any business abroad, particularly in US, London. London, I remember 90% of the restaurants at certain places are controlled by Indians only. If you go in that lane in London, I've seen that lane, you'll find as if it's an Indian lane. Punjabi restaurants, then Tamil restaurants, Malayalis, lot of people have opened restaurants. And they do all kind of business there, permitted. They have nursing homes, they have hospitals, they have got kirana shops, multiple departmental stores, all that. But in India, hell a lot of restrictions. The foreigner cannot come and open a branch in India. One restaurant they cannot open. Chinese restaurant is only for namesake. Once you go inside a Chinese restaurant, you don't find any Chinese there. You don't find a foreign barber also inside the country. You don't find a foreign professional. Why all this? Because of the stringent regulations, the Foreign Exchange Management Act, which you have now. But remember, all this is going to change. It's just a question of time. Let India sign the GATT agreement. Let the services sector be opened. It's a question of time, maybe 3 years or 4 years. World advanced countries are putting a lot of pressure to open up the service industry in India. And once the service industry is opened, you have the foreign professionals, foreign persons coming inside the country, then you will know what exactly is competition inside the country. Anyway, we are slowly opening up. The world is becoming a small village. That's what I've been telling. But having told all this, we should always try to achieve self-sufficiency. That's why in that 42nd class, I've spent a lot of time trying to tell you the background that how to conserve our foreign exchange and use the foreign exchange only for essentials, not to waste the precious foreign exchange. So when we were discussing about the acquisition of immobile property by non-resident, very stringent guidelines were there. Then, of course, once the NRIs or person of Indian origin, they purchase the immobile property in India, then what about the sale? Once they sell, can they take out the foreign exchange? There are a lot of restrictions, and I've gone through all that, and quite a lot of questions are given in these areas. So calmly read all those things. Then what about the export of goods and services? In export of goods and services, Customs Act will come, of course, the export duty and all. Then Foreign Trade Act, import-export regulations will come. Then was the role of Reserve Bank of India. Reserve Bank of India is bothered because of 2-3 areas. Valuation. Otherwise, are you exporting goods and services with proper value, or is it going through Hawala transaction? That's why a lot of restrictions you have. You have to give a declaration to RBI, and until you get the proceeds, then until the declaration is cancelled or file is closed, the RBI is going to be at back of you. So RBI role is to see whether the valuation is done properly, whether the foreign exchange is properly received inside the country. And certain exports are permitted without declaration. That list also, please go through very carefully. A lot of questions are given. Then we discussed what is the time limit within which the exports realization has to come to India. So it has to come to India within 9 months, all that whatever you exported goods and services. But let me give you one issue to the COVID, to this. We are passing through a very bad time now, the COVID-19 virus throughout the world. So in light of this virus, some relaxations have been given. And students don't have to panic. Those small relaxations, they are only temporary phase, which will be changed. And that you don't have to bother for the November 2020 examination. I get a lot of phone calls from the students. So recently the institute has given a lot of extra points to remember. Don't have to read anything. You take it from me. Even if you write what I've given in the book, those time period or the revised time period, both are correct. So COVID restrictions, those small relaxations, they are only temporary in nature. That is nothing to do with the students understanding the subject as such. Don't bother with that. So you always write 9 months is the period within which the exports of goods and services, the payment has to come inside the country. Of course, in certain cases, they permit up to 15 months. All those points are given. And also there is another list. While most of the export of goods and services go through declaration method, some export of goods and services require prior approval of RBI. This list has been changed now. Previously, you had a lot of items, even lease and other hire purchase were there, all that they have removed now. So go through that list. RBI prior approval. It's not through declaration method. Then what will happen in case of delay in receiving the payments and all? Then RBI will ask you to bring additional security before they give you time extension, or they will ask you to bring back the goods. So until you get the foreign exchange or goods back, RBI is not going to leave you. Then advance against exports. Small areas. Most of the students have no patience. You should develop tons of patience. Advance you pay for exports. There are a lot of restrictions. Because no doubt the foreign exchange inside the advance receipt inside the country, no doubt it is foreign exchange coming inside the country, still the respect and status of the country is involved. So whether you can take advance, if so, how much interest you can pay, what is the period within which the goods are to be exported, all those restrictions are there. Up to then, we have covered in class number 45. In class number 46, I have continued the Foreign Exchange Management Act with the realization, repatriation, and surrender of foreign exchange. So what is repatriation? Having realized the foreign exchange in the various currencies, we spent the most time on repatriation of foreign exchange. Most of the students have a wrong impression. Repatriation of foreign exchange means bringing the foreign exchange inside the country. Wrong. It has an extended meaning. Repatriation means not only bringing the foreign exchange inside the country and surrendering the foreign exchange and converting into rupee. That is one meaning. Second is bringing the foreign exchange inside the country and keeping in the foreign exchange accounts in the form of RFC account or EFC account to the extent permitted. And third meaning of repatriation is the adjustment of transactions. Suppose you have to receive some foreign exchange from a person outside India, you have to pay foreign exchange to another person. Instead of bringing all that here and sending across, with the permission of RBA, direct book entry transaction you do, that also come under the definition of repatriation. So all that I've explained. Then exemption from realization and repatriation. What is the provisions of the Act? Previously, the rules under were included in the syllabus. That has been excluded. So whatever is relevant to the syllabus only, we are discussing there. Then some previous year questions also we have discussed. Then the subject now turns to the various persons who are authorized by Reserve Bank of India to do foreign exchange business. Who are all those people? I have spent a lot of time discussing authorized persons. Authorized persons are of three types: authorized dealer, authorized money changer, offshore banking unit. Of course, offshore banking unit is not covered in your syllabus. So the focus will be authorized dealer, authorized money changer. Authorized dealers are nothing but, you can't call them as agents of RBA, because when you put as agent, then principal agent relationship will come. Authorized dealers are those people appointed by the RBA to do certain transactions under the Foreign Exchange Management Act. Authorized dealers. In fact, 90% of the functions are performed by authorized dealers only. State Bank of India Foreign Exchange Division is authorized dealer. Bank of Baroda Foreign Exchange Division is authorized dealer. So these people get a license from RBA under FEMA to do certain transactions. Now come back. Once it is a capital account transaction, and once you take RBA approval, RBA is not going to release the dollars or foreign exchange. RBA will give you approval. With the approval, you have to come to authorized dealer. He is the person, the banker, who will convert your rupee into foreign exchange or foreign exchange into rupee. Then, even if it is a you exempted capital account transaction, you have to come to authorized dealer. He will do the conversion process. Then come to current account transaction. If the RBA approval, if you have taken, or central government approval you have taken, they won't release the dollars. Taking those approvals, you have to come to authorized dealer. So fill up the forms. So authorized dealer is the only person, the banker, will do all the functions connected with the foreign exchange for commercial purpose. He will charge his own fees. So I have explained who is this authorized dealer. Then authorized money changers. Authorized money changers are of two types: RMC, restricted money changer, and FMC, full-fledged money changer. Full-fledged money changer is a person who can receive foreign exchange as well as make payment in foreign exchange. Restricted money changer can only receive the foreign exchange, it cannot give foreign exchange. And who are all these people? You find a lot of money changers at the airports who are just converters. Then you have five-star hotels who have taken this RMC license. You got this travel agents, like that. Certain people, as a part of business transaction, they may be required to deal in foreign exchange. So they have to take this RMC or FMC license, and then to a limited extent, they can deal in foreign exchange. They are only converters. They just convert for consideration rupee into dollar or dollar into rupee. I've explained all that. Then comes the very dry area, control mechanism of RBI over this authorized dealer and authorized money changers. And very unfortunately, I've given all this in the examination. What are the duties of this authorized retailer, money changer? What are the powers of Reserve Bank of India to inspect the books and other records of all this? In other words, I told in a jovial way, if RBI says you stand, you have to stand. Run means you have to run. Jump means you have to jump. Don't write all this in the examination. So the complete control mechanism of Reserve Bank of India to control the activities of all these authorized money changers and authorized dealers. So what are the books of accounts they can inspect, what are statements they want you to produce, whatever information they want you to give. Otherwise, they are all punishable. Then comes the penalties. Two types of penalties. One is penalty which RBI can levy to the authorized dealer in case he has violated the provisions of the section 3-4 times he has given figures itself. Then the regular penalty. Now, in the Foreign Exchange Management Act, one important feature is imprisonments have been totally removed because we are in a comfortable foreign exchange position, no imprisonment. But huge penalties have been prescribed. Imprisonment will arise only when you don't pay the penalty, otherwise, no imprisonment. So then there are quantifiable offense, non-quantifiable offense. Well, transactions and all, if you know what is the quantifiable offense, then the penalty will be 3 times of the amount. If it's a non-quantifiable offense, that is procedure-related offense, then the punishment can go up to 2 lakhs. All that penalties go through very carefully. Apart from levying the penalty, the law also focuses more on this. The law also focuses more on confiscation of currency. What about the foreign exchange which they have seized? What are the procedure to confiscate? And if you have not seized the foreign exchange, what about the orders given by the authorized persons to get the foreign exchange inside the country? All those points are covered. Then procedure for adjudication. As I told you, under Foreign Exchange Management Act, Reserve Bank of India has got a separate department which is called Enforcement Department. And also in the Reserve Bank of India itself, you have got under the FEMA, they are not only administrative authorities, they are also quasi-judicial authorities like SEBI and all. So they themselves will have the hearing. They'll be authorized, there'll be adjudicating authority who is the officer of RBA who will conduct the judicial, quasi-judicial proceedings and punish the concerned person. So then from the adjudicating authority, and that is the prosecuting authorities, Reserve Bank of India and the Enforcement Directorate of Central Government, then the matter will go to adjudicating authority. You are not happy with the order of the adjudicating authority, adjudicating officer, you'll go to Special Director Appeals, from Special Director Appeals to Appellate Tribunal, or directly also from the adjudicating authority, you can go to Appellate Tribunal. And from there, directly Supreme Court, all those appeal provisions are also, we have discussed very much in detail there. So everywhere this will be repeated. What are the powers and of these adjudicating authorities, Special Director Appeals, Appellate Tribunal? Then, of course, I said not directly Supreme Court, you can go to High Court, and thereafter to Supreme Court. Then compounding of offenses. So compounding of offense, just like we saw in the SEBI, here also certain offenses can be compounded, which means converting huge fines into lump sum penalty. What is the procedure for compounding of offenses? Until then, I discussed in class number 46. Now, class number 47 is very, very important from the student perspective. New amendments, new areas have been brought into the purview of your final examination. That is, 3 topics have been added. One is import of goods and services. What are the guidelines? Then ECB's external commercial borrowings, and then foreign investments outside India. These are the 3 areas which they have added, and all the 3 have gone through a lot of changes. The material which I have given you is the latest material, and please follow only this material. So don't worry about the changes which they have suggested. I have incorporated all those changes in the material which I have given. So in the import of goods and services, what you have to read? The guidelines are some 5-6 points are there. Anything you can give in the examination. For example, how do you pay the foreign exchange? Through international credit cards, postal appraisal form, on that basis. Then what is the time limit within which you are to settle the import payments? Then if you want extension of time, what procedure you are to follow for getting the extension of time? Then what about in getting foreign exchange inside the country? For example, you travel abroad, you bring foreign exchange in the form of currency or postal orders, you come by flights or you come by ship. What are the restrictions? What declarations you are to give? Then what about the guarantees? What are the restrictions? What are the limits? All that points are covered in foreign exchange outgo because of the import of the goods and services. Then external commercial borrowings, ECB guidelines, lot of changes has taken place. I have told in my class what areas you focus. You don't have to read the complete guidelines and all, not possible also. So the focus will be more on the from who first list is who are the people who can get the external commercial borrowings, ECBs. So one is you have 2 listed: foreign exchange borrowing, Indian currency borrowing. Who are the people in India who can borrow, forms of borrowing? Then what is the period for which they can borrow money? And what is the overall cost of borrowings? What is the rate of interest? Then who cannot borrow? Negative listed. So those business who are doing real estate activity, investment in capital market, big list is there. These people cannot borrow. Then what is the exchange rate? How they have to do the conversion? Those points are there. Then the limits are all very important. All the eligible borrowers can borrow up to $750 million. In the automatic route, 2 types of route is there: approval route and automatic route. My God, see the relaxations which you have got. 750 billion, no mistake in my figure, 750 million US dollars, they can borrow money as such, external commercial borrowings. Then what about the issue of guarantees by Indian financial institution? Then quickly run through the procedure for raising the ECB. As I told you, automatic route and approval route, 2 types of routes are there. Then what are the powers of automatic route now delegated to category 1 bankers? Then the guidelines, if for any reason you are not able to repay the external commercial borrowings, under what conditions you can convert into ECBs? Then what security you can give for external commercial borrowings, those guidelines. Then some special guidelines have been given for startup companies. Startup companies, how much they can borrow, some simplified guidelines have been given. Of course, those who have borrowed earlier, they are subject to investigation, they cannot borrow. This much you go through, which I have emphasized what to read and all in those guidelines. Then overseas direct investment by resident individuals. That is, our people, they were allowed to permit in industries outside India to a limited extent because it involves outflow of our precious foreign exchange. So what is direct investment outside India? What is joint venture, wholly owned subsidy? who can do the investment, Indian party, all that. So here also you got automatic route as well as approval route. So in the automatic route, these figures you try to remember because they can be given the multiple choice questions also. So now all the eligible people who are basically foreign exchange earners, they can invest up to $1 billion US, up to $1 billion without RBI approval. More than $1 billion, the RBI approval is required. This is, of course, subject to limits that it should not exceed 4 times of your paid up capital free reserves. That is your net worth, up to which you can invest. More than that requires RBI approval. In what form you can invest? 100% of the equity, convertible debentures, 100% in the form of loan, in the form of guarantee, of course, 50% in the form of performance guarantees, all that you can. Then what is the process? All that I have discussed. Then approval route. One is automatic route, second is approval route, then general permission, which is granted. So with this class number 47, the Foreign Exchange Management Act I have completed. So I almost spent almost 7 classes, 6 to 7 classes in the Foreign Exchange Management Act. And probably you will get only a question up to 5 to 7 marks, maybe short questions, one or two in multiple choice you will get. Anyway, this is the way you are to read. Certain topics will be quite easy, doesn't require explanation, but certain topics require a lot of explanation. Then for the new syllabus students, they have added 2 topics in the other acts, Foreign Contribution Regulation Act and the Arbitration Act. So in this 48th class, I have focused and concentrated on Foreign Contribution Regulation Act of 2010. I've given a lot of background. Now, whatever I told in the Foreign Contribution Regulation Act is not my creation. This is all the background under which the government has formulated the Foreign Contribution Regulation Act. The idea is a lot of foreign money in the form of donations come inside the country. They are used by Christian missionaries for conversion purposes. They are used by certain communal elements to formulate trouble inside the country. All that is regulated. You should have seen in the newspapers about a week back, hundreds of these NGOs whose licenses have been cancelled by the government because much of the foreign money which have come inside the country has been used to create internal disturbances in the country, destroying the fabric of social democratic republic. A lot of explanations are given. So the basic idea of this Foreign Contribution Regulation Act is to regulate the foreign contribution received in the name of charity inside the country. And you have these definitions are important. What is foreign company? What is foreign source? What is foreign contribution? So foreign contribution is not only in the form of currency. It is foreign currency, Indian currency. It is also gift. This is an amended section. Previously, the value of the gift was 25,000. Now they have increased the value to 1 lakh. Small amendments have included all that. Where go through. So if you send a gift also on any article whose value is more than 1 lakh, it comes under the definition of foreign contribution. Then certain people are prohibited from receiving any kind of foreign contribution, candidate for election, and all the people connected to the press, whether electronic media, print media, then members of legislatures, judges, government employees, then political parties, office bearer thereof, then this electronic media, everyone have been prohibited because these people, they bring a lot of foreign contributions inside the country. They influence the press, they influence the people, they propagate communal ideas, all that the government wants to stop it. So no doubt, there are a lot of charitable activities and good things which are done. At the same time, the money is misused. So the central government is very, very clear on this Foreign Contribution Regulation Act. Foreign contributions have been regulated. Then what kind of foreign contribution is allowed? That list we saw. Then up to certain limits, certain donations and all will be allowed. The second part is foreign hospitality. That is also regulated. So we have to define what is foreign hospitality. Then see, familiarity breeds contempt. I've been telling this. So unnecessarily, you should not enjoy foreign hospitality. There are a lot of government employees, other people go on official work, and they enjoy the local medical treatment, local transportation, boarding and lodging, transport, local transport. Then obviously, obviously they cannot, I mean, there's a presumption rather, they will not reflect the interest of the country. So I've explained all this in detail. What is this foreign hospitality? So there is no prohibition of foreign hospitality. When these people go abroad, they only require the prior approval of the central government before they receive the foreign hospitality. Then all these charitable institutions and other people who are doing certain good work, all these NGOs, they trust Section 8 companies and the societies. There are two ways of getting the approval from the central government. Here the central government is Ministry of Corporate Affairs, New Delhi. Two ways of approval. One is registration method, second is prior approval method. Registration method is you should have already been in existence for 3 years, you should have certain net worth, all those, and you can regularly get the foreign contribution without RBI approval. And you have to file a lot of returns. The second method is prior approval method. You are not likely to get foreign currency on regular basis. Only from 1 or 2 people you can get it. Then instead of taking registration method, you can apply to the government that I am likely to get so much amount from so and so person. That is called prior approval method. Then lot of procedures. These are all areas you should never leave. Then we are talking of renewal of the certificates, then suspension when they'll do it, then all those. Then what are the powers of the government? Then certain miscellaneous areas, he gives a lot of questions. For example, an NGO or any organization who have received foreign exchange under this category, can they give the money to another NGO? Yes, if so, what limits? If the other NGO is also registered on FEMA, then you can give. They're not registered with certain approvals, you can give all those restrictions. You have to go through. Then, whatever foreign money you receive, there are certain restrictions. You cannot use more than a particular limit. You cannot use more than a particular limit up for certain purposes, all those. Because too much administrative expense if used there. Then what about the maintenance of accounts? What about the audit and all? Here also you've got adjudicating officer. If any violation is there, they may confiscate the foreign currency. Then where you have to go to appeal, revision of order. Then offences by companies who will be punishable if the offence is committed. Then compounding of certain offences under Foreign Exchange Management, Foreign Contribution Regulation Act. So with this, I've finished this 48th topic. So students, please go through this very, very carefully up to this chapter number 48. So for 49th one is Arbitration Act. So arbitration, what is arbitration? The basic definition I've given in class number 49. Then what is this role of the courts in arbitration? What is arbitration agreement? Then who can be appointed as arbitrator? What matters can be referred for arbitration? What matters cannot be referred for arbitration? How many number of arbitrators? Then how do you appoint the arbitrator? And bias in the appointment of arbitrator. So in the Arbitration Act, I discussed in class number 49 up to this. So go through this very much in the examination. So last time, if any questions are there, I'll be glad to answer. So far, I've not received any questions from the students, either through email or any method. Come on.
Sir, I have received one question from Surabhi.
Tell me.
Sir, it is, since sitting fees is not derived from articles in a private company where 1 lakh limit is not applicable, can they pay sitting fees of any amount even if articles are silent? Is the question, sir.
See, I only said that sitting fees limits are prescribed by the government will apply only to public companies. That limit will not apply to private companies. But articles can very much regulate the sitting fees. Sitting fees can be paid even in private companies only when the article provide. The basic understanding is wrong. Expense reimbursements only will be as per articles. Sitting fees, the inner limits can be provided by articles. The outer limit, if articles doesn't provide for sitting fees, how can you pay sitting fees? They are regulated by the articles, regulatory measure. So in a private company also, if you want to pay more than 1 lakh, you shall pay only as per the articles. I repeat this point again. In private company, if there is no provision, the articles for payment of sitting fees, unless you amend the articles, you can't pay sitting fees. The power is not derived from the articles. I never said that. The articles can very much regulate even in private companies. It's not that in a private company, when the articles are silent, they'll pay crores of rupees as sitting fees. Not at all. So you have to create a provision in the articles. As an auditor, you have to go through that very carefully. Even private company, there must be a provision in the articles regulating the sitting fees. Any other question?
So
No,
I
sir, I
had a question.
That's all. Okay.
Hello.
So
So am I
thank you.
audible?
Any other student?
Hello.
Yeah, tell me.
Morning, sir. So I had a doubt in one of the question in 188. See, the question is 179, sir. Question number. So it says there are two parts in the question. One is where Mr. Kamlesh, son of a MD, is being appointed as chief executive, and the remuneration is 75,000. So one part of the question, we don't require the prior ordinary resolution to be appointed.
Wait. What is the question number? You said
179, sir.
1 minute. Just give me a minute and just look into the question.
Yeah.
You have the page number of my material?
Yeah, it's 93, sir.
Oh, great. Yeah, 93. Kamlesh, yeah, tell me.
So, I got the first half of the question, but the next one says, will it make any difference if Kamlesh is appointed as whole-time director on the same remuneration?
Yes.
So I didn't get that part. So it says section 188 is not applicable. Can you explain that?
Yes. See, this is the point you should have read very carefully. What is the definition of holding office or place of profit? To come to the basic definition, holding office or place of profit means if this full-time director, managing director gets over and above than what they are paid under the Companies Act, then only it's a related party transaction because they are holding office or place of profit. Now, this 75,000 you are paying to Mr. Kamlesh is in the capacity as full-time director that is paid under the Companies Act. So where is the question of related party transaction? Where is the question of holding office or place of profit? That is why the second part of it, I said, if he is appointed as full-time director, then the remuneration of 75,000, whatever you are paying the capacity as a director under the Companies Act. If it is a profit-making company, it will come under the 5% limit. If it is a loss-making company, it will come under the Schedule 5. So where is the question of holding? That's why the structure, I spent a lot of time trying to explain what is related party transaction under that, what is holding office or place of profit. I repeat again, for managing director and whole-time director, whatever they get under the Companies Act, I spent a lot of time on that. You should have concentrated. Whatever they are paid under the Companies Act, that sitting fees, expense reimbursements, 1%, 3% commission for ordinary directors, 5%, 10% for all the whole-time director, managing director, it will not attract related party transaction. It is not holding office or place of profit. Office or place of profit will come only when they are paid over and above. The definition itself I told. That is why if he is paid the 75,000, the capacity as a full-time director, the whole section will not apply. I think you got it.
Yes, sir. But so the second part of the question, we are not taking that Mr. Kamlesh is son of managing director. We are not taking that, is it? Because if we take that for the second part, he will again become the relative of the.
No. That relative part, you forget it. Don't take it.
Okay.
We are
That's what I
directly
got.
approaching is a whole-time director. Over.
Got
I
it,
got
sir.
your
That's
point.
where
We are directly taking that is a whole-time director. Leave it. He may be a relative, doesn't matter. That part will not. Because again, it comes to same point. He is occupying what position?
Correct.
The position is whole-time director, managing director. So the payment again is the criteria. So in that position, if you are making payment, so relative aspect will not come into picture.
Got it, sir.
Good.
Got it.
Thank you.
So I
thank
have
you
one
very
more
much.
doubt. Yeah. I think we're getting late. Should I keep it for the next class or can I finish it, sir?
No problem. Tell me.
One sec. Sir, there was an example that you gave for the disclosure of interest in the slide, sir. So I just made a note of it. So in that, sir, 184.1, we say directors' relatives' interest need not be disclosed, right? So in that one example where the director holds 1% shares and the relative of director holds 1.5% shares. And the question was, does 184.1 apply? And you told you told it's yes, and it 184.1 applies.
184.1 doesn't apply because you don't have to disclose the interest. If it is covered under 184.2, then probably it will apply.
Okay. So for 184.1, we see only the director's.
You see only the director's interest. Maybe in some framework of mind, I might have told 184.2 only will apply.
Only for
because directly or indirectly. For 184.2, it will apply.
Okay. So for 184.1, the relative share is not at all taken.
Not at all considered.
Yeah. Okay. Thank you, sir.
Thank you. Thank you very much. Thank you. All the best.
Thank you, sir.
We'll meet again next Sunday.
Thank you, sir.